So of course you had already looked at the income statement extract. I think we had looked at already the income statement extract. So had we looked at the income statement extract or not? I think let's start with the income statement extract. So the income statement extract. The income statement extracts. The income statement extract. So that was that was a question number 4A for August 2022. So there's that place I was having to tell you when I left that you prepare the income statement extract and of course the statement of financial position extract. So it was for 3 years. It was for 3 years. So we had the year 2019, the year 2020, and of course the year 2021, the year 2021. So there was in the income statement extract, quite obviously in this case, we are going to recognize what? You're going to recognize the incomes and likely expenses. And of course, there's no income that we'll end up having to recognize because in the question, we had no income. But I think we had what you are calling what? Depreciation. Depreciation. We had what you're calling what? Depreciation. So we'll compute the depreciation, which in this case, the right of use of these assets, we had already in this case been able to, so the right of use of the asset was actually 1273, but of course the lease liability was actually 1243,425. 1243,425. So we'll get the depreciation on that lease liability. So 1243, 425, and of course the lease was for 3 years. In the question, the useful life of this asset is 5 years. But remember what I told you in this case, if you are given the useful life and of course you are given the number of years for the lease, you take the number of years for the lease, which in all circumstances will be less than the useful life. So you will depreciate by using the number of years of the lease. So if you divide, in this case, you'll get 424, 475, 424, 475, 424, 475. Then, of course, you have in this case the interest that we computed in our interest, or we can refer to it as the finance cost. The finance cost. So the finance cost, we have the finance cost. If you look at the amortization schedule, I think there is an interest that we computed. So the first year it was actually 124,343. 124,343. And of course, second year it was actually 86,777. 86,777. Then for the third year it was actually 45,455. 45,455. So those are the what that is the interest, because those are the only expenses we end up having to capture. Then we can come up with a statement of financial position, extracts of financial position extract. Statement of financial position extracts. So for this particular company, statement of financial position extract. So you'll start with the non-current assets. Non-current assets. So for the non-current asset here, you'll have the right of use of the asset. Right of use of assets. The right of use of the asset, but of course, this right of use of the asset. So remember, we have 3 years. So we have 2019. We have 2020. We have 2021. So the right of use of the asset we had actually computed, if you can recall, we had actually computed, it was actually 1273,425. 1273,425. So we'll end up having to less the accumulated, you less the accumulated depreciation. You less the accumulated depreciation. So in this case, the right of use of the asset is actually 1273,425. 𝒑𝒂𝒑𝒆𝒓, 1273,425, 1273,425. Depreciation in the first year is actually this one. So you less that one, 424, 424, 475, you less. So that was the accumulated depreciation in the first year. But of course, for the 2020, the accumulated. So this one plus this one. You add that one, that plus that one, you get 848, 950, 848, 950, 848, 848, 950, 848, 950, 848, 950. So what do you get when you divide this one? I think that figure there should be the useful life, should actually be the right of use of the asset. So let's see what you are getting there. So 1273, 425 divided by 3. So this one is supposed to be 12, the right of use of the asset, 1273, 425. So it's not 1243. This one is 1273. It is the right of use of the asset. So then you depreciate for 3 years. So 1273, 425, you divide by 3. You get the depreciation per year. So correct, this one is not 1243, but 1273. That is the right of use of the asset. You divide by 3, you'll get these particular amounts as what? As depreciation. Then the right of use of the asset is this one. For the first year, the accumulated depreciation is actually 424. For this 2020, you add the 2, you'll get the accumulated up to 2020, 848, 950. Then for the 2021, you add the 3 of them, you'll get 1273. You'll get 1273, 425. It means by the final year, so the value of this asset will actually be depreciated up to 0. So you can be able to get the net book value. So the net book value of the asset, the net book value of the asset, you simply minus. Hope you've been able to see how we've gotten this one. This is the accumulated depreciation for each and every year. So for the first year, it is this one. For the second year, you add the 2 because they have used it for 2 years. So it's depreciated this one plus this one. Then for the third year, it is the 3 of them. The accumulated is the 3 of them, like that. So that is how you get then that. Then you get the difference. If you get the difference there, you should be able to get here 848, 950. This one you should be able to get 424, 475, 424, 475. So that is the value of this particular asset. That is the value of this particular asset. Then you go to the non-current liabilities. Non-current liabilities. Non-current liabilities. I don't know whether it will fit there, but we can just be able to move here, no problem. So you continue, just continue. So the non-current liability. So you have for 3 years, so 2019, 2020, and of course 2021. So 2019, 2020, and of course what? 2021. 2020, 21. So so the non-current liability here is of course what? The lease obligation. So the lease obligation. Because also you have the current liability. We have the current liability. So of course here we have still what? The lease obligation, the lease obligation. So remember in this case what we said. That under, in this case, determination of the non-current liability and of course current liability, for the non-current liability, if in this case this lease is actually having to be paid in arrears, if it's actually having to be paid in arrears, then the non-current liability in this case, you'll end up having to take the balance carried down. You'll take the balance carried down, and of course for the current liability, you'll take what? The principal amount. And of course all of them you consider from the second year. So you need to go to your amortization schedule. So from the amortization schedule for 2019, what will we be able to recognize? what will we be able to recognize as the lease obligation as an non-current liability? From the amortization schedule. From the amortization schedule. What will you be able to recognize as the lease obligation for the year 2019? Can you see you're saying 454, 546? 454, 546. So that is correct. 454, 546. What about for 2020? What about for 2020? What about for 2020? It will be 0. These ones will actually be 0. Then what about the current liability? 2019 will take which figure? 2019, what about the current liability from the amortization schedule? We'll take which figure? Remember we said you take the principal amount from the second year. The principal amount from the, so you have 413, 413, 223. So this one is 413, 223. Then of course this one is 454, 454, 546. Then this one is 0. So like that. And of course, you'd have already come up with what your income statement extract. And of course, now in this case, what your balance sheet extract. So I want us in this case, we look at now, how will you end up having to treat these leases? For example, if it happens that the lease payments or the rental payments are having to be paid what in advance. Remember, what you ended up having to look at is exactly what when they're having to be paid in arrears. There was someone who was asking, what do you mean by arrears? Arrears, it means you're having to pay at the end of the period. The lease payments you are paying at the end of the period. Kama umerent nyumba na inapatikana kwamba unalipanga mwisho wa mwezi, hiyo unalipa in arrears. But we said normally, as per the tradition in Kenya, you know, for rent, you normally pay what in advance. Unalipanga mwezi kianza. Wani unalipa kwanza ndio unaanza kutumia that lease for that month. So it is in advance. But if it's in arrears, it means the lease payments, the rental payments are having to be paid at the end of the period. They're not having to be paid at the start. So what we've been looking at in this case, it is that is whereby in this, for example, these lease payments are having to be paid what at the end of the period when the year has come to an end. But now what we want to look at is before the lease commences, you pay the first lease payment. How will you end up having to undertake what the treatment? How will you be able to account for such? So that is what we mean by in this case when they're actually in arrears or in advance. Kama ni rent, kama iko in advance, unalipa mwezi ikianza. Kama iko in arrears, unalipa mwezi ikiisha. But normally in this case, what I know, so most of the lease payments or lease agreements regarding rent here in Kenya, so the landlord will call upon you to pay what? The deposit plus the rent for the first month. Then you start staying in that house or having the right of use of his house will commence from there. Will likely commence from there. So you can be able to write in this case, accounting for leases paid in advance. Accounting for leases paid in advance. Accounting for leases where there's payment in advance. Accounting for leases. Accounting for leases. Accounting for leases. Paid in advance. Paid in advance. And of course, in this case, I want us straight away we look at an illustration. So that in this case, from the illustration, we'll be able to know how in this case you normally account for this. How you normally account for this. So you can write is a very small illustration. You can be able to write the illustration, then we look at it very fast. There's an illustration I want us we look at. There's an illustration I want us we look at. So illustration, you can be able to read a company. You write a company. a company enters into a 4-year lease. A company enters into a 4-year lease commencing. A company enters into a 4-year lease commencing. A company enters into a 4-year lease commencing 1st of January 2019. A company enters into a 4-year lease commencing 1st of January 2019. A company enters into a 4-year lease commencing 1st of January 2019. And intends to use the asset for 4 years. And intends to use the asset for 4 years. And intends to use the asset for 4 years. And intends to use the asset for 4 years, full stop. And intends to use the asset for 4 years, full stop. The terms are 4 payments. The terms are 4 payments. The terms are 4 payments of Kenyan shillings 50,000. The terms are 4 payments of Kenyan shillings 50,000. Kenyan shillings 50,000. At the start of each and every year. 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 At the start of each and every year, full stop. The interest rate on the lease, is 7.5%. The interest rate on the lease is 7.5%. The interest rate on the lease is 7.5%. And the interest rate on the lease is 7.5%. And the present value of the lease payments not paid and the present value of the lease payments not paid as of 1st of January 2019 and the present value of the lease payments not paid as of 1st of January 2019 is shillings 130,000 is shillings 130,000 0 26 130,000 0 26 130,000 0 26 130,000 0 26 full stop. The direct cost to set up just say not to set up, but the direct cost to enter into the lease, the direct cost to enter into the lease was shillings. The direct cost to enter into the lease was shillings 402. The direct cost to enter into the lease, the direct cost to enter into the lease, was shillings 402, was actually shillings 402, was exactly shillings 402. Shillings 402. Shillings 402. Shillings 402. Required, then semicolon, required, then semicolon, required, semicolon, required, semicolon. Show the lease liability, from 1st January 2019. Show the lease liability from 1st January 2019. Show the lease liability from 1st January 2019. 1st January 2019 to 31st of December 2022. Show the lease liability from 1st January 2019 to 31st of December 2022. 31st of December 2022. And come up with the financial statements extracts, and come up with the financial statements extracts, and come up with the financial statements extracts, and come up with the financial statements extracts. So show the lease liability from 1st of January 2019 to 31st of December 2022, and come up with the financial statements extracts. I can see you're saying repeat. I don't know where I repeat from. I don't know where I'm repeating from. So you say the interest rate is 7.5%. The interest rate is actually 7.5% per annum. I don't know whether I said per annum. The interest rate is actually 7.5% per annum. Is 7.5% per annum. And the present value of the lease payments, and the present value of the lease payments, and the present value of the lease payments is 130,026, 130,026, and the present value of the lease payments is 130,026, 130,026, 026. You know, I don't know what time you want me to grant. You're not indicating the time. You're not indicating for me the time there. You're just saying prayers. So I don't know what is it, what time you want. You want the 10 minutes. So in this case, you're having to say the direct cost, you need to indicate for me whether it is 12:50, whether it is 7, whether it is 7:30. I don't know. You're just saying 10 minutes, 10 minutes, 10 minutes, 10 minutes, 10 minutes, 10 minutes. So the direct costs to enter into the list, we've been able to say exactly 402. So hope you captured the required. So we can take the break. Then when we come back, we do the question. We do the questions. We can take the break. It won't be 10 minutes. It will be 7 minutes. It will be 7 minutes. Yes, I think now we can proceed. We can proceed and start. We can proceed. I can see you are saying you're already back. You're already back there. We can proceed. We can proceed. We can proceed. We can proceed. So, of course, in our question here, you can be able to see that they're having to say that this particular list is actually running from the year 2019, 2020, 2020 till 2019, 2020, 2021, then 2022. So it is actually for 4 years. But you can see in the question there, they're having to say that a company enters into a 4-year lease commencing 1st of January. So it commences this particular year, 2019. And the asset is intended to be used for 4 years. The terms are 4 payments of 50,000 at the start of each and every period. So at the start of each and every year. So remember, the lease is actually commencing on 1st of January 2019. So on this 1st of January 2019, this debt, they immediately pay 50,000. They immediately pay 50,000. And of course, they'll likely be paying at the start of each and every year. At the start of each and every year. At the start of each and every year. So this one is having to be paid in advance. So if you want to see the difference, the previous questions we did, they were having to say they pay what? They pay the lease payments on 31st of December 2019 at the end of the year. So that is in arrears. That is in arrears. You've already commenced utilizing the asset. You've already commenced utilizing the asset. But now in this case, you end up having to pay for the lease payments after you've used for like a year. So that is actually what in arrears. But in this situation, maybe circumstance here, what is happening before you start using the asset, they call upon you. The lessor calls upon you in this case to do it, to pay first of all the first installment, which is actually 50,000. And because you'll be paying like that in advance, at the start of each and every, until the 4 years actually do what? Come to an end. Until the 4 years actually do what? Come to an end. They actually come to an end. So of course, you can be able to remember in our previous situation under arrears, under payments having to be made in arrears, we were having to do what? Get the lease liability. We were having to get what? The lease liability. The lease liability. Whereby in this case, we were looking at the present value of these lease payments up to the end of the lease. What is the present value of these lease payments up to the end of the lease? Up to the end of the lease. And in that case, we were able to get what? The lease liability. Whereby we were having to say, you need to look at what? The fair value. The fair value of this liability, the fair value of this asset. The fair value of this asset, you end up having to do what? To get the present value of the lease payments, to get the fair value of what? Of this asset, that in this case, you've been able to do what? To lease. You've actually been able to lease. So in our situation, in this case, you can be able to remember, if to get the lease liability, we are doing present value interest factor over annuity for the 4 years. It was actually for the 4 years. It was actually for the 4 years. So it was actually for the whole 4 years. So we'll take the whole 50,000 for the 4 years. But now in this case, if it is having to be paid in advance, remember, since this amount is having to be paid at the start of the year, it is already in the present. So we can't get the present value of an amount you've already been paid. Remember, the other ones, they are paying what? At the end of the year. And of course, you are commencing to start at this particular start of the year. You have to know the present value of the lease liability at the start of the year. But of course, you'll pay these lease payments at the end of the year. But remember here, you've already started paying. Unaanza kutumia asset na ushalipa 50,000. Huwezi tafuta present value ile pesa ushalipa. You only in this case get what? The present value of the amounts which are still outstanding. So the present value here of the lease liability will likely be for what? For the 3 years. Will be for the 3 years. Will likely be for the 3 years. So in this case, for us to be able to get the lease liability here, of course, you've already been given exactly 130,026. They have already given you the present value, which is actually 130,026. They have already computed for you. They have made life easy for you already. They have already made life easy for you. But of course, in this case, if it happens, they are not giving you that present value. They are not actually giving you that present value. So to get the lease liability, lease liability, the lease liability on commencement, the lease liability on commencement, the lease liability on commencement of the lease, on commencement of the lease. This is how you could have ended up having to compute it. So you get the present value, you get actually the present value of this amount you are calling what, the 50,000. Remember here they paid 50, the lease payments. So 50,000, 50,000. So you get the present value. So you get the present value. So you get the lease payments, lease payments due. You multiply by, in this case, what, the present value interest factor of annuity. In this case, it was for how many years? It will be 3. It will be 3. So the rate is actually 7.5%. Remember, the interest rate is 7.5%. It is for 3 years. And of course, I've already been able to explain why we'll do that. So suppose the lease payments here is actually 50,000. You multiply, in this case, by, I hope you can be able to remember how you are getting the present value interest factor of annuity. It was 1 minus 1 plus R into negative R. So in this case, our R here is 0.075 raised to negative. It is 3 years, 1, 2, 3. 1, 2, 3. So in this case, you divide by 0.075. 0.075. Try to do the math, you see what you're having to get. Just try to compute, you see what you are getting. Try to do the math there, you see what you're having to get. So this one is 1. Try to do the math there, you see what you are getting. Monique, are you having your calculator? Monique, are you having your calculator? Try to do the math and tell me what you're having to get. So 130,026. So of course you've already been given, but if you had not actually been given, that is how you could have been able to compute. Take note of the difference. Take note of the difference with how we are getting the lease liability under what? Under payments in arrears. Under payments in arrears. So that is what I wanted to come out. That is what I wanted to come out. That's how you end up having to get what? The lease liability. That's how you end up having to get what? The lease liability. So of course, in this case, now we can be able to come up with the amortization schedule. The amortization schedule. And of course, also the amortization schedule will have some difference. It will have some difference a bit. So how you present the amortization schedule will have some difference a bit. So you need to also, in this case, to take note of the difference. Take note of the difference. As why in this case, we are coming up with the amortization schedule, because that is very important. That is very important. So in this case, we'll have the period. We'll have the period. We'll have the period. Then, so after the period, we'll have the balance brought down. After the balance brought down, in this case, we want to go to interest, like what we were doing previously. But here, you'll have the payment. You'll have the payment because they are paying in advance. They pay first at the start of the year. So they'll have a balance brought down, then they pay at the start. They pay first. So they pay first. Then in this case, they'll be, once they pay, there'll be a balance due. Balance due. Then on the balance due in this case is when, in this case, the balance due will be realized, for example, by the end of the year is how much. Then in this case, they'll be able to now compute interest on this. They'll compute interest on this one because our interest is 7.5%. 7.5%. Then after that, you'll have the balance carried down. You'll have the balance carried down. So take note of how, in this case, we come up with the amortization schedule is actually a bit different with our previous one. Is a bit different with our previous one. Remember, this is in our previous one, we were having balance brought down, then we have the interest, then you have, in this case, the payment, then in this case, the balance due, then of course, now in this case, what? The principal amount, sorry, the principal amount, then of course, in this case, what? The balance carried down, the balance carried down. So it was actually a bit different. So we had the opening balance or the balance brought down, then the interest, then of course, the payment, then the principal amount, then the balance carried down. But take note of how in this case we are coming up with this, and it is because they make the payments once they have the balance at the start of the year, they immediately make the payment at the start of the year. So they first of all pay. Then once they pay, they'll have a balance due. On this balance due, which will be at the end of the year, they'll have to compute interest on it. Then they have a balance carried down. That balance carried down is when they actually bring it forward. So we have in this case the 4 periods. So they have 2019, 2020, 2021, and of course 2022. 2021 and of course 2022. So we've been able to calculate the lease liability. The lease liability by the start of this year 2019 is actually 130, 0.26. Then remember this lease liability, this particular lease liability here was actually on the 3 years. So the amount initially had already been paid. It already, by the time we are computing this lease liability here, they had already paid the 50,000. And you can even recall our lease liability is on what? The 3 years here. So this initial amount paid here, we don't actually consider it because this lease liability, that amount is not considered in this what lease liability. This lease liability is just what for 2020, 2021, 2022. The 3, you remember the 3 years, subsequent 3 years. So it means the initial payment of 50,000, you won't put it here. Because on this lease liability, we've actually been able to compute. We haven't considered it because they paid first of all before they started counting the lease liability or the present value of the lease liability having to be counted, or the fair value of the lease liability having to be counted. And therefore, in this case, our initial payment here will end up having to be 0. But for the other years, is actually 50,000. It is actually 50,000. It is actually 50,000. It is actually 50,000. Then the balance due, so of course they are paid nothing, so it will be 130, 0.26. Then you compute interest. Compute 7.5% of this. Try to compute and tell me what you're having to get. Just compute very fast and tell me what you're having to get. 7.5% of this balance due. Remember, in this case, they compute the interest at the end of the year. So this is the balance that is actually due by the end of the year. So kwa hiyo pesa iko outstanding, wanachapa interest juu yake. Wanachapa interest juu yake. So how much are you having to get when you compute 7.5% on 130,026? 97.52. So 97.52, 97. So therefore the balance carried down to the coming year, ujue ilikuwa balance due. So lazima uongezee interest. Hiyo unajua hiyo lease iko na interest. So hiyo lazima uongezee hapa juu. So ukiongezea hapo juu utapata 139, when you add it to 139, 780, 770 what? 778. So 139, 778. So and therefore in this case our balance brought down itakuja hapa 139, 778. So they paid 50,000. When you minus 50,000 from this one, so remember this was the amount due by the start of the year. Na tumesema wanalipa mwaka ikianza. So ilikuwa balance carried down by 1st of January 2020, but wanalipa at the start. Mwaka ikianza tu hivi wanalipa 50,000. So inamaanisha in this case, the balance due when they paid immediately in this case is actually 89,778. Then you compute the interest on this amount. You'll get something like 67.73. Then in this case, the total here, you'll be able to get something like 96,551. So just try to do the computation. You'll be able to see. Then you carry that one here. It will be 96,551. Then you minus 50,000. You'll get 46,551. 46,551. Then you compute interest on this. You'll be able to get here a figure of 34,88. Then you add the two. It comes to 50,039. 50,039. Then this one you carry it, you bring it here, 50,039. Then when you minus, you remain with 0. When they pay at the start of the year here, we'll come back in a 50K. Kuna tu pesa juu, but it is because of rounding off or something. But now in this case, it comes to 0 like that. So once they pay this due amount by the start of the year 2022, then the lease liability would have actually done what? Come to an end. It would have actually come to an end. So that's why in this case, you come up with what? The amortization schedule. So immediately, in this case, I want you to tell me whether you've been able to complete. So we have now in this case, remember we said that when you'll be coming up with the balance sheet extract, you'll have to compute the figure for the right of use of the assets. The right of use of the asset, you have to determine it. So I hope you are still remembering what we learned in the previous class, because you said in this case, to get the right of use, this is what you take to the balance sheet extract as an non-current asset. How do you come up with it? In this case, you take the lease liability, which you've already been able to compute. To make compute ndo ile 130,026, 130,026. But remember, there's something I was having to tell you. If you are a very keen student, I told you, if there was a payment that was made, immediately they commenced on the lease, you'll have to add it. Then you'll have to add any direct cost incurred on the commencement of the lease. For example, in that case, there's a direct cost of how much? 402. And of course, immediately they were commencing this particular lease, they paid how much? 50,000. So in this case, payment on commencement, it was how much? 50,000. Then of course, now in this case, there was a direct cost. Direct costs, it was an amount of 402. 402. So it means the right of use will be able to take to the balance sheet extract, as in this case, what? The non-current asset will likely be 180, 428. 180, 428. 180, 420. And of course, that is what you'll end up having to do, what? Depreciate. So remember, this asset was actually leased for how many years? 4. So if it was actually leased for 4 years, it means our depreciation is equals to 180, 428 divided by 4. Because it was leased for how many years? 4 years. So for us to get how much was the depreciation per year, we divide the right of use of the asset by the number of years in use during the lease. The number of years in use during what? The lease. So you divide 180, divide by this, you'll be able to get an amount of 45,107. 45,107. 45,107. 45,107. 45,107. Gitonga, are we together? Gitonga, are we together? Gitonga, are we together? Gitonga, are we together? Yes, so I think we are together. So I hope you've been able to copy this one, because I want us we come up with the extracts. I want us we come up with the extracts. Take note that in this case, there are 2 key differences we've seen when you compare with that one that we pay in arrears. When you are coming up with what? The lease liability, you consider what? The subsequent years. Not the year under which they started making the payment, but the subsequent what? Years. So for example, in this case, under the one in arrears, we were considering all the years when you are coming up with the lease liability. So you're having to do what? Discount these lease payments, all of them, the 4 of them. But now in this case, if it is having to be paid in advance, we only compute this lease liability on what? The subsequent years. And therefore, in this case, it will be 3 years. The interest rate is this one. The lease payment is actually how much? 50,000. You come up with the lease liability at the start of what? Of the year. Then, since they made the payment immediately, this lease liability we've actually been able to come up with. Here under payment, there's nothing that is having to be paid. We only start having to pay what? In the subsequent year at the start of what? Of that year. Because I've already been able to give you the reason. When you are coming up with this lease liability, we never considered the 50,000 here. So the payment here will likely be what? Will be 0. And therefore the balance due, then in this case, you put interest on it. Then also in this case, you get what? The balance carried on. Also of so much importance, take note of the table. It is a bit different. If you compare with the one in this case, we were having to do what? For example, come up with the amortization schedule is a bit different when we are coming up with what? The one that is actually having to be paid in what? In arrears. So take note of the difference. So that is very important. So I want us in this case to come up with the extracts, because time is not on our side. Time is not on our side. So the income statement extracts. the income statement extract. So income statement extract. Income statement extract. Income statement extracts. Income statement extract. So in this case, we have the year 2019. 2019, we have 2020. 2020, we have in this case 2021. Then we have in this case 2022, 2022, 2022, 2022. Maybe I could just be able to ask, what are we going to consider in the income statement extract? What are we going to consider in the income statement extract? Which items are we going to consider in the income statement extract? Which items are we going to consider in the income statement extract? Depreciation. What else? Depreciation is exactly correct. What else? Interest. So I think at least my students are getting where we are heading to. At least they are getting where we are heading to. So we have the interest expense, which now in this case, this one you can be able to get it from the amortization schedule that you've been able to come up with. So if you look at the first year, it will like 97, 52. In this case, we have 67, 33. We have in this case 34, 3488. This is 3488 or 08. 3488 or 08. 3488. I think 3488. Then this one is 0. This one is 0. Then this one is depreciation. We've been able to compute our depreciation. We've gotten an amount of 45, 107, 45, 107, 45, 107, 45, 107, 45, 107. So that is the income statement what extract. Then we can come up with a statement of financial position. Statement of financial position extract. Statement of financial position extract. Statement of financial position extract. So in this case, we have 2019, 2020, 2021, and 2022, and 2022, 2022. So like that. So in this case, we'll have obviously the non-current asset. Non-current asset, we have the right of use of the asset. Right of use of the asset. So the right of use of the asset here. The right of use of the asset here. So of course now in this case, it was how much? 180. We computed it is 180,428. 180,428. 180,428. 180,428. 180,428. But now you need to minus what? Less the accumulated depreciation. Less accumulated depreciation. So the depreciation in this case in the first year, we have it here. It is here 45,107. So this one will be able to less 45,107. But now here you'll have to add the two. You'll have to add the two. When you add the two, how much are you having to get? When you add the two, 45,107, I think you'll get 90. You'll get 90, 214. I think it's something like that. 90, 214. Is it 90, 214 or something? So you should be able to get 90, 214. Then for that other one, 45,107 times 3. This one will get 135,321. 135,321. Then this one, I think it will be 180,428. 180,428. So it means this one is 0. This one is 45,107. 45,107. This one is 90,214. This one is 135,321. 321. So this is the value of the asset. Those are the values of the assets. So we have 135, 321 for this year. Then we have 92, 14, then 45, 107. So if you understand how we are getting the accumulated depreciation here, we are simply adding. So this one is for this year. By the year 2020, you accumulated the 2. You get this one. By the year 2021, you accumulated the 3. Because it has lost value for the 3 years, you accumulate. Then for the final, you accumulate the 4 of them. So 184.28. Then you'll be able to get the net book value. The net book value of the right of use of the asset, which is these amounts here, which is actually those amounts there. Those amounts there. Those amounts there. Those amounts. I don't know why Gitong is asking why not cumulative. So I don't know what you want a clarification there. So then in this case, we have the non-current liability. The non-current you just continue non-current liability. You just continue non-current liability, non-current liability. So of course, also we have the current liability. Current liability. We have the current liability. It is for the 4 years. So you just continue there. So we have 2019 like that. So I think this space is a bit small. So let me rub some things here. I'm going to rub this one. Hope you've been able to copy it already. Hope you've already been able to copy it. So I'm going to rub that one. I've rubbed one column there so that we can be able to fit some things here. So non-current liability. Non-current liability, and of course you have the current liability. So of course, under the non-current here, we have the lease obligation. Lease obligation. So it is for the 4 years. So 2019, 2020, 2021, and 2022. So you just continue like that down there. So of course you have the current. So this one is still, we have the lease obligation. Lease obligation. So take notes. Remember, in this case, as for the one that we're having to pay in advance, we were having to say that in this case, for the non-current liability, you take the balance carried down from the second year. You remember the lease obligation here under non-current liability, you take the balance carried down from the second year. And of course, this one you're having to stay, you take the principal amount from the second year. So here, under this one having to be paid in advance, so you can put your note there. Here, under this one having to be paid in advance. So for the non-current liability, you'll take the balance due. You'll take the balance that is actually due at the end. You'll take the balance that is actually due at the end. Then, of course, in this case, for the current liability, you'll take the payments. You'll take the payments. And still the same case, you consider from the second year. You consider from the second year. So here, under the one that in this case, you're having to pay in advance, for the non-current liability here, for the lease obligation, you take the balance due. The current liability here, you take the payments. You consider from the second year. You consider from the second year. And therefore, in this case, if you look at our amortization schedule, our balance due in the second year is actually an amount of how much? 89,778. 89,778. So it means that in this case, our long-term liability by the year 2019 is the one that in this case is having to be incurred or is actually due in 2020, which in this case it will actually be 89,778. 89,778. Then of course, in this case, this one is 46,551. So this one is 0. This one is 0. Then of course, you've been able to say for the lease obligation under the current liability, you will take the lease payments. You'll end up having to take the lease payments, and you actually consider from the second year. So if you look at our lease payments here, is actually an amount of 50,000. So 50,000. Then of course, this one will be 0. It will actually be 0. And of course, in this case, you would have come up with what? The statement of financial position, what? Extracts. The statement of financial position extracts. Statement of financial position extracts. That's why in this case, you come up with what? This one, for the one that is having to be paid in advance. The one that is actually having to be paid in advance. So I want us we shift gears. I want us we start looking at, in this case, of course, I know you've already been able to look at it, but now this will be a far much better chance for you to just refresh on this particular area and grasp it once for all. It will be far much better for you to be able to grasp this area and you grasp it once for all. I want us we look at business combination or consolidation, or what we refer to as group accounts. So business combinations, business combinations, or in this case, what we refer to as consolidation, or sometimes you might hear people having to say group accounts, group accounts. I know you already looked at it, but now this is a far much better chance for you to just, in this case, do what? Grasp for this particular area once and for all, once and for all. So when you talk about, in this case, consolidation, or in this case, business combinations, sometimes you end up having to find entities operate as what we call a group. They operate as what we call a group. That in this case, we have a company. For example, I think I have my company law students here. So we end up having to say that in this case, a company is actually a separate legal entity. And of course, a company is actually a person. A company can be able to own property. It can be able to own property. So part of the properties a company can be able to own is, for example, acquiring shares in another company. And of course, that will end up having to happen, whereby we can have a company will end up having to buy shares in another company. And therefore, as a result of this, it becomes an owner in that other company. So it means that in this case, whenever, for example, this kind of a company that has acquired shares in that other company, it means that when they are coming up with, for example, their financial statements, they'll have to consolidate. They'll have to do what we call consolidation, or putting them together. Them as an entity that has acquired shares in that other company. And therefore, in this case, they combine the books of this company that is buying shares in the other company, that is the holding company, and maybe the subsidiary, or it can be an associate, or it can, in this case, just be what we call maybe a simple investment. So they'll be what we call combination of the books of accounts. So therefore, in this case, they'll combine the books. It is exactly what you're calling in this case, an associate. What you're calling not an associate, but actually a subsidiary. For the associate, they'll use another method of combining the books of accounts, which we call the equity method. And that, I think, you must have actually been told. So therefore, in this case, we can give an example. We can be able to give an example. So we have which company can we be able to give as an example that operates as a group? So I think you people can be able to give me an example. Which companies do you think operate as a group? So I can be able to see you are saying RCM. You are saying equity. So for example, equity, they have what we call equity holdings. So under equity holdings, you find that in this case, maybe they operate an insurance business. They operate, in this case, a bank. They operate a bank. And of course, other companies. I can see you are saying KCB Group. So of course, most obviously, in this case, under KCB Group here, we have maybe in this case a number of subsidiaries. One that actually deals with the banking business. We can have one that is having to deal with also the insurance. We can have one that in this case is having to deal with maybe investments. Cooperative bank. In this case, we have cooperative bank. What I know, I think cooperative bank has one subsidiary, which we call the Kingdom Bank. I think Kingdom Bank. So it was Jamii Bora Bank. So now in this case, it is Kingdom Bank. So cooperative in this case can operate as a group, whereby we have now in this case Kingdom Bank, and of course these other business of cooperative that in this case is having to do undertake businesses regarding maybe banking. So we can have in this case companies having to operate as a group, and therefore it calls upon, for example, a company like in this case maybe equity holdings as a group. When it is coming up in this case with its financials, the books of accounts of all these subsidiaries must actually be consolidated together. And therefore in this case come up with just a single income statement, and of course a single statement of financial position, or for example in this case a single group cash flow statement. And therefore ideally what we are going to look at here under business combinations or consolidations is how eventually do you come up with this kind of accounts. This kind of accounts whereby you have to combine the books of accounts with the subsidiaries of equity, you come up with together. What is the procedure? What is the process? As to in this case, you end up having to do what? Combine these books of accounts, these books of accounts. So that is what you're going to look at. And therefore, in this case, I just want us to be able to note down some key terms, and of course, part of the initial procedures or stages as to how you likely end up having to do what we call the consolidation process. The consolidation process. So you can be able to write definition of key terms. Definition of key terms. Definition of key terms. Definition of the key terms. Definition of the key terms. Definition of the key terms. So you can start with the first one here, consolidation. Consolidation. What is actually consolidation? Consolidation, or you can say business combination. Business combination. Consolidation, or you can say business combination. So you can write this about consolidation or business combination. You can simply just say, it refers to bringing together. It refers to bringing together of separate entities. It refers to bringing together of separate entities. It refers to bringing together of separate entities into one reporting entity. 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 It refers to bringing together of separate entities into one reporting entity, full stop. Business combination will bring together. Business combination will bring together. Will bring together, or will bring about. Don't say it will bring together. Business combination will bring about. Business combination will bring about a parent subsidiary, will bring about a parent subsidiary relationship. Will bring about a business combination will bring about a parent subsidiary relationship. A parent subsidiary relationship. Then what is of course now in this case what? A subsidiary. You can write number 2 term, a subsidiary. You can write number 2 term, what is actually a subsidiary? What is actually a subsidiary? You can write number 2 term, a subsidiary. It is an entity that is controlled. It is an entity that is controlled. It is an entity that is controlled. It is an entity that is controlled by another entity. It is an entity that is controlled by another entity. It is an entity that is controlled by another entity. By another entity, you put in bracket parent company. You put in bracket parent or holding company. Parent or holding. You put in bracket parent or holding company. You put in bracket parent or holding company. It is an entity that is controlled by another entity. You put in bracket after another entity, parent or holding company. Then you close the bracket. Close the bracket. For more than, by more than, you can be able to say by more than 50%. By more than 50%. By more than 50%. By more than 50% of its equity capital. By more than 50% of its equity capital. By more than 50% of its equity capital. So what we mean in this case, this holding company has bought shares in the subsidiary worth more than 50%. For example, if the share capital is 1 million, they have bought 500,000 plus. 500,000, it is supposed to be plus. It is supposed to be more than, because in this case, if it is 50-50, it ends up having to be what we call a joint venture. Joint venture. So, and therefore, in this case, we're having to say it has to be 50% plus or more. So if it is 50% plus or more up to 100%, then it means that kind of a control will lead to what we call a subsidiary. That kind of a control will be able to lead to what we call a subsidiary. So there's a term we're having to mention, control. What is actually control? you can write term number 3, control. What is actually control? Control. It is the power to govern. It is the power to govern. It is the power to govern the financial. It is the power to govern the financial and operating policy. It is the power to govern the financial and operating policy of an investee and operating policy of an investee company. Investee company of an investee company. Investee company is the company which has been invested in by another company. Like now in this case, Kingdom Company becomes the investee company. Cooperative Bank becomes what? The investor. Becomes the investor in Kingdom Bank. So we're having to say it is the power to govern the financial and operating policy of the investee company, Then you can be able to write term number 4, consolidated financial statements. Consolidated financial statements. Consolidated financial statements. You can write consolidated financial statements. Then you write this about that. These are the financial statements of a group of companies. These are the financial statements of a group of companies. These are the financial statements of a group of companies. These are the financial statements of a group of companies presented as a single entity. 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 Then the last term, you can be able to write non-controlling interest. Non-controlling interest. Non-controlling interest. Non-controlling interest. Non-controlling interest. It is the proportion of the net assets. It is the proportion of the net assets. Controlling interest, or NCI. Sometimes you predominantly hear they having to say NCI. It is the proportion of the net assets in the subsidiary. It is the proportion of the net assets in the subsidiary that is not owned by the parent company. It is the proportion of the net assets in the subsidiary that is not owned by the parent company. It is the proportion of the net assets in the subsidiary that is not owned by the parent company. And of course, now in this case, when you talk about net assets is equals to what? Net assets is equals to what? Net assets is equals to what? Net assets. How do you get net assets? How do you get net assets? Net assets is equals to what? Assets minus what? Liabilities. Or alternatively, you can be able to say in this case, it is the component of equity. It is just the component of equity. Because in this case, when you say assets is equals to capital plus liabilities. Capital plus liabilities. And therefore, in this case, to get capital, you take assets minus liabilities, which is the same thing as capital, which you're having to say it is what? The net asset. Which you're having to say it is the same thing. Net assets and of course the capital component. So it is the capital component. It is exactly what? The capital component. The capital component. And of course, in this case, here, for example, when we start looking at how you determine the NCI, or non-controlling interest. So of course you're having to say you take a proportion, you basically in this case consider what a proportion of what of these assets or these net assets. We'll basically be looking at a proportion of what over the capital or the equity element, So that's what we'll be able to see when we start having to look at how you account for the non-controlling interest. So therefore, in this case, you're having to say we can have a group. And therefore, in this case, if we have a company that has acquired ownership in other companies, we'll end up having to do what we call consolidation of their financial statements to having to be one. So there can be different ways. That's why in this case, the company has been able to make its investments, and therefore it leads to different kind of group structures. So it leads to different kind of group structures. You can be able to write group structures. What are the group structures that can end up having to arise regarding acquisitions and investments in other companies? What are some of the group structures that can actually end up having to arise regarding investment and acquisition of ownership in other companies? So we can have what we call group structures, the group structures. So group structures. So group structure number one we can be able to have is the horizontal structure. Horizontal structure. Horizontal structure. It is the horizontal structure. It is the horizontal structure. So you can write this about horizontal structure. It is where the parent company acquires. It is where the parent company acquires. It is where the parent company acquires. It is where the parent company acquires controlling interest. It is where the parent company acquires controlling interest in one or more subsidiaries. It is where the parent company acquires controlling interest. It is where the parent company acquires controlling interest in one or more subsidiary. In one or more subsidiary. So the structure will likely look like this. It will look like this. So we can have in this case XYZ Limited. You can have XYZ Limited. It has made investments in company A, investments in company B, investments in company C. And that in this case, in this company, they have acquired 80% stake. This one 75% stake. This one they have acquired 65% stake. So you can see this is one of the subsidiaries. So we have A Limited, we have B Limited, and of course you have C Limited. So it is horizontal. You can see how it is moving. It is horizontal. So if they continue investing, they can invest in another one, which you can call D. In D, maybe in this case, they can invest maybe 72%. So it will be horizontal. It will be continuing like this. It will be going like this. It is horizontal. So they have made investments? Direct investments in a number of subsidiaries. They have made direct investments in a number of subsidiaries, and therefore they have control in a number of subsidiaries. That is what we refer to as as a horizontal structure. Horizontal structure. Then in this case, we have the vertical structure. We can have the vertical structure. We can have the vertical structure. Vertical structure. So number two structure, we can be able to end up having to have how companies have made their investments or acquisition of ownership in other companies. Vertical structures. We can have vertical structures. Vertical structures. Write this about a vertical structure. It occurs where the parent company, and of course, at this particular point in time, when I mention the parent, I hope you know what I mean. It is the holding company, the one that is actually having to acquire shares in another company, acquire controlling interest in another company. We'll refer to it as the parent or the holding company. So it occurs where the parent acquires controlling interest. It occurs where the parent acquires controlling interest in a subsidiary. And the subsidiary acquires controlling interest in another subsidiary. It occurs where the parent acquires controlling interest in a subsidiary, and the subsidiary acquires controlling interest in another subsidiary, and the subsidiary acquires controlling interest in another subsidiary. This one will end up having to look like this. It will likely look like this. It will look like this. So we'll have XYZ Limited as the parent company, Then in this case, it acquires an ownership stake in A. Then A, the subsidiary, acquires an ownership stake in C. So this one, of course, is the subsidiary. It is the subsidiary. So maybe the ownership stake here could be maybe 80%. Then this particular subsidiary, maybe it has acquired again how much? 80%. In this one becomes to this one, this one becomes the subsidiary. It's not a direct subsidiary. So close to this one is a direct subsidiary, but to this one becomes a subsidiary. So still in this case, this holding company or parent company will have control in the two companies. It will have control in the two companies. And therefore in this case, the control in A is actually 80%. The control in A is actually 80%. And therefore in this case, the non-controlling interest in A is 20%, exactly 20%. Then in this case, the control in C, the control in this one C, the control in C will, how do you end up having to get it? It will take 80%. You'll actually take 80% by 80%. 80% by 80%. So 80%, you multiply by 80%. You multiply by the 80%. So 80% by 80%. So this by this, you'll end up having to get what? 64. So it will lead to what we call what? 64%. 64%. So the control, this particular control here is actually 64%. 64%. So this one indirectly controls this one by 64%. And therefore, in this case, the non-controlling interest in C, the non-controlling interest in direct non-controlling interest in C will likely be 36%. So because it must actually be able to add to. And so that is in this case what you mean by what it is vertical. You can see it is going. Maybe you can find also this one has acquired. So the structure will continue going like that. This one subsidiary has acquired another one. So you still do the computations. 80% by 80% by the percentage that will be here. Maybe it can be 60%. It will be 80% by 80% by 60% to get the control. If it continues, maybe to have even what? D, like that. So it will be vertical. It will be going like this. Remember, the other one was horizontal. So they were making direct. It was direct from here. But now in this case, this was indirect. You can see it is indirect control. As a result of what the subsidiary they have acquired has acquired shares in another company. And therefore, they'll have control over what? C. Because you can see it is a percentage of what? 64%. So long as it is beyond 50% plus, there is what? A control. There's a control. In this case, it is not actually what? An associate. There's what you're calling what? A control. There's actually what? A control. And then in this case, we can be able to have a structure that is just mixed up. A structure that is actually just mixed up. So how do you end up having to determine the control if the structure is just mixed up? The structure can just be mixed up. So if it is mixed up, you don't have to be mixed up as a student. You don't have to be mixed up as a student. So you can write structure number 3. Structure number 3 is what we call a mixed structure, is what we call a mixed structure. So of course, what is actually a mixed structure? You can be able to write something briefly about a mixed structure. It occurs where the parent acquires a control in a subsidiary. It occurs where a parent acquires a control in a subsidiary. And the subsidiary acquires control, and the subsidiary acquires control of another subsidiary, acquires control of another subsidiary, within the same group, acquires control of another subsidiary within the same group, acquires control of another subsidiary within the same group, acquires control of another subsidiary within the same group, So the structure will likely end up having to look like this. It can actually look like this. You can have X, Y, Z here, XYZ here as the parent, XYZ here as the parent company. So of course it has actually acquired an ownership stake in ABC. Then of course in this case, maybe it might be having also an investment. It might actually be having an investment in another company, DAB Limited. So this one is ABC Limited. This one is XYZ Limited. So the stake here could, for example, in this case, this one is 80%. Then of course this one, maybe they have acquired 25%. So that becomes what? It becomes an associate. Then in this case, maybe what has happened here, ABC has actually also acquired an ownership stake in DAB Limited. And therefore, maybe in this case, it can be, let's say, for example, 40%. So there's actually 40%. So that becomes what a mixed structure. So as interest or XYZ interest, so XYZ interest in XYZ interest in DAB Limited. What will be the interest of XYZ? So of course the interest it has in ABC Limited is automatically 80%. Is actually automatically 80%. But now the interest it will have in DAB Limited will have this 25%. Then you have the indirect. So it will be this one plus this one that is actually indirect. So the direct control is actually 25%. But now we have the indirect control, which in this case is actually 80% by 40%. So it's actually 80% multiplied by 40%, which actually comes to 32%. So if you add the two, you get 57%. 57%. So that becomes what? The control of XYZ Limited in DAB Limited. So it is this 25, then plus the indirect. The indirect you get by 80 by 40. Then you add the two, you get 57%. So therefore, the overall control here in DAB Limited will be 57%. So it will be controlling 57% of this and 80% of this. When you are consolidating, you'll have to make what that consideration. That is exactly what 57%, and therefore the NCI is actually 43. Those are some of what the structures you can actually end up having to have. So of course now in this case, there's something else we've actually been able to mention. You can be able to have what you call what a subsidiary, and you can be able to have what you call what maybe an associate. You can actually be able to have what you call what an associate. So when you talk about in this case an associate, then it means that the acquisition of the ownership stake in terms of equity by the holding company is actually 21% up to what? 20% up to 50%. Is actually 20% up to 50%. Remember, if it's beyond 50%, then it becomes what? A subsidiary. But in this case, if the ownership stake of the parent company in that other company is actually between 20% to, in this case, what you're calling what? 50%, then there's no control here. There's no control here. So because in this case, there's no control, their method as well in this case will consolidate or combine an associate will be different. We'll use what we call what the equity method. And of course, we'll be able to see how in this case you utilize what you're calling what the equity method. How you utilize what we call what the equity method. The equity method. But of course, now in this case, it's very important, it's actually very important you try to understand other things regarding, for example, what you're calling what goodwill. There's of course in this case what we call what goodwill. There's, for example, in this case, transfer or exchange of goods amongst what subsidiaries, and all those what maybe intra-group sale of fixed assets, unrealized profits. So how you deal with those ones, we'll be able to look at it tomorrow. Then I think we'll be able to start looking at the first illustration tomorrow. But I think for today, let's just end there. So try to comprehend what we've already been able to learn. So we'll finish up with the introduction. Then I think we'll do a question. We'll be able to do a question on group accounts. We'll do a question or illustration, on group accounts, which I know it will just be a refresher. Because you had already covered in your discussion. Any question you might be having? You can ask before we disperse. So I shared the notes for the theories. I think someone was asking the notes for the theories, which I shared. So you can actually be going through them. As you try to refresh. I can see you asking for the other class. I think they are uploaded. So I don't know. What you ask. Hope. I think I know. As per now, I know. All the classes I think I've done have already been uploaded. Apart from today's class. I think that is what I mean. Apart from today's class, all the classes I've done have actually been uploaded. They have all been uploaded. So hope you need to be careful where you are checking. All of them have actually been uploaded. Apart from the one we have done today. Is one that is actually not uploaded. So make sure when you go to the folders, you check very keenly. You'll be able to see all the classes have actually been uploaded. So tomorrow we'll have a class. If you have a challenge to get the videos on the LMS, let me give you a number. You can call, you'll be guided. Let me give you a number there. Anytime you have a challenge or issues about videos on the LMS, you call this number. Let me give you the exact number. So there is that number there, 0794 78 0000. So you'll get a gentleman behind the phone. He'll be able to assist you. So his name is Clinton. His name is Clinton. He'll be able to assist you. Whenever you have a challenge, always call. So he'll tell you, for example, where the videos are. If you're not accessing, maybe there could be a problem. He'll be able to assist you. He'll be able to assist because he's the one who is in charge of uploading and also assisting students on matters LMS. So anytime you have a challenge, just call him. He'll be able to assist you. He'll assist you. So thank you very much, and let's meet tomorrow.